Hey guys, in today's video I'll be introducing you to micro and macro structure, Dow's 6 tenets and the concept of fractals. Without further ado, let's jump into today's video. Before we look at Dow tenets, it's important for us to have a good understanding of market structure and how the charts traders use every day actually form. To do this, we need to first consider some basics of market structure. Market structure is simply the collection of all the price action that is shown on the charts, and you understand market structure by looking at how the candlesticks, trend lines and swing points all work together within the market. These levels and areas of the charts are the key areas, and there are typically a lot of eyes watching them, especially in the higher time frames. Every trader with even just a basic knowledge of technical analysis should know how to identify these levels, and therefore it's vital to understand market structure and familiarise yourself with how to interpret the market and what it's actually telling us. Markets trend in 3 directions, and understanding how to read the continuation of a trend, failure of a trend, or lack of a trend is vital when interpreting market structure. The first type of market is a bull market, which is depicted by higher highs and higher lows. The trend will continue in that direction until a higher low fails to form, and price instead forms a lower low. It's usually a good indication that the trend is exhausting if price fails to form a higher high, and therefore you should pay close attention to the price action around this point. If you then see a lower low being formed, then it will suggest that there's a change in the trend. The second type of market is the bear market, which is formed from lower highs and lower lows. Once price cannot form a lower low and instead forms a higher low, this is a suggestion that there may be a trend reversal and you should be keeping an eye out for that higher high. The last type of market is the range or sideways market. Price forms equal highs and equal lows, and this is often a period of consolidation within the market as price is not forming higher lows, higher highs or lower lows. This trend is broken if the price breaks to the upside or downside of the range, and this will usually be dynamic in the form of an impulsive move in either direction. It's important to remember that this range can be broken from either side, but it's more common to see a break in the direction of the trend that price was in before settling into the range. Market structure and price trends vary across the different time frames that you choose to trade on. If you're a position trader, you may see a different trend on a daily chart that is actually completely opposite to what a day trader sees on the intraday time frames, such as the 15-minute chart. Let's imagine that we're looking at EUR/USD going up in a clear bull trend on the 15-minute time frame. But as you zoom out more and more, it becomes clear that instead we're in a small pullback in a persistent downtrend. Let's now look at this in a bit more detail. The different perspective of what is going on in terms of the market structure across higher and lower time frames is referred to as micro and macro market structure. Micro versus macro structure is a really important concept because you don't want to trade against the overall dominant trend. This comes back to the classic trading quote of "the trend is your friend until the end when it bends." This concept is ignored by the majority of novice traders who focus their attention on microstructure and will often not look at the macro structure, meaning that when they're thinking about entering a bear market short, they're actually getting involved in a retracement of a longer term bull market. It goes without saying that the probability of a trend continuing is significantly higher than it reversing, and therefore going against dominant macro structure in the market is foolish and will reduce the likelihood of your systems being profitable. Let's now head on to trading view and we'll take a look at fractals in a bit more detail. Let's for a minute pretend that the green line on our screen represents bullish price action, and this means that we're currently in an uptrend. As you know, we order a trade with the trend, and hence we would be looking for long positions here. However, if we now zoom out a bit, you'll notice that these red lines appear on our screen, which we're using to show bearish price action. As we zoom further and further out, you'll see that these red lines are actually much larger than our green line, signifying that our green line didn't actually show that price is in an uptrend. Instead, it showed that we were currently in a retracement period of a downtrend, and that the downtrend continued, shown by the red line after the green one. However, if we keep zooming out, we'll see more green lines creep onto our screen, which now actually show that price is in an uptrend, and that the red lines we presume to show a downtrend is actually just a retracement of the higher time frame uptrend before price turned around and continued in an uptrend. The important thing to take away from this is that you always want to keep in mind what is happening on the higher time frames, and always look for macro structure, i.e. the higher time frame picture, rather than just getting too bogged down on the micro structure that you see on the 1-minute chart. Now we have the concepts of micro and macro structure as well as fractals out of the way, let's now take a look at Charles Dow and who he was, as well as the 6 tenets of trading. Much like Wyckoff, Charles Dow is regarded as one of the founding fathers of technical analysis. He was born in 1851 and died in 1902, and spent his life as a journalist in America after founding the Wall Street Journal. Although the Wall Street Journal is still publishing to this day, in my opinion, Dow is best known for creating the Dow Jones Industrial Average, alongside co-founders Edward Jones and Charles Bergstresser. The Dow Jones, which you may know as the US 30, was originally composed of 12 blue chip stocks and is a price-weighted average, and after its creation it was developed and 18 additional blue chip stocks were added to the collection, and that's why it's called the US 30 and not just the US 12. Possibly one of the most common misconceptions about Charles Dow relates to the creation of Dow Theory. This theory was not actually created by Dow, and in fact was released as part of a book written by William Hamilton and later followed up by books from Robert Ray and George Schaffer. Whilst there is merit and validity in most of the concepts within Dow Theory, some of them are no longer applicable to the mechanics of the financial markets, and therefore, although we will discuss all the 6 of the tenets which this theory was based around, it's important to remember that some of these concepts are a little bit more valid than the others. The first tenet is the averages discount everything. Now this shouldn't be interpreted literally. In fact, what Dow is referring to is that price discounts everything. He stated that everything is known by the market, including expectations and hopes and fears. This, in more simplistic terms, is referring to the fact that the price displays the live effect of every cause that is affecting the market. Whilst this tenet is completely valid and correct, it's also worthwhile knowing that at the time, there was no reliable data when it came to fundamentals. This changed in 1932 when the Securities Act was created, which basically stopped people lying and manipulating the fundamental figures. Before this time, Joe Bloggs on the trading floor could publish that a mine had struck gold in the middle of the UK without any legal repercussions. As a result of this, I imagine that Dow placed a heavy emphasis on price action to reveal the truth relating to the fundamentals rather than those reporting the figures. The second tenet is the market has 3 trends. Dow suggested that there are primary, secondary and tertiary trends within the market. Primary trends are the highest time frame trends. These are the trends that cover several years of price action. Primary trends are the highest time frame trends. These are the trends that cover several years of price action. Secondary trends are the second highest time frame of trend, and are usually trends that have been in motion for around 1 to 3 years. The tertiary trend is the lowest time frame of trend, and this accounts for trends which are seen over a period of months or even weeks. Now this concept of hierarchy of trends allows us to dip our toes into the concept of fractals again within the markets. As we've just seen, this ties in really nicely with macro and micro structure and the concept of the market being fractal. Looking at this further, imagine we have a long-term bearish primary trend on our monthly time frame. If we were to take a look on the lower time frames on the secondary and tertiary time frames, we would likely see the same trend occurring progressively on a smaller scale. This doesn't mean that there will be perfect harmony between the monthly and the 1 minute time frame. This doesn't mean that there will be perfect harmony between the monthly and the 1 minute time frame, but rather the primary trends movement will be made up of numerous small renditions of the larger move. The third tenet is major trends have 3 phases. This concept is primarily based around psychology and more specifically herd mentality. It also has minor links to Wyckoff's theory of accumulation and distribution within market cycles. These 3 phases are accumulation, public participation, and the distribution phase. These phases can be seen clearly on the example shown just here on the right. We can see the accumulation phase on the left hand side of the chart, which is where the smarter money and the early adopters are beginning to enter the positions in their markets. During this period we can see a steady bullish trend, which then takes us into the public participation phase. During this phase, the asset will be published all over mainstream media as it skyrockets, forming higher highs every single day. The idea of buying in the morning and selling at night for profit will also contribute to this public hysteria, and during this period smarter investors are beginning to close out their positions which they've accumulated during the initial accumulation phase. At this point we will then see price begin to fall, and following this decline we will typically see price retrace as retail investors think they're getting into the market at a good price, followed by a lower high signifying the end of the uptrend. At this point we're in the distribution phase and sellers are beginning to push price lower. I'm sure that you'll know someone who was caught up in the BTC hysteria and someone who is still banking on Bitcoin forming higher highs in the future, but just make sure they aren't caught out by the same cycle and they're always managing their risk properly when they're trading on this asset, as it's often known for its volatility. I actually used the exact same analysis for one of my students to predict the recent turning point in XRP, so this theory is definitely quite useful in a lot of circumstances and actually is really evident on the crypto market. The fourth tenet is actually no longer relevant, however, it is that averages must confirm each other. In this tenet, Dow is referring to the Dow Jones Industrial Average, or DJIA, and the Dow Jones Transport Average, which I'll shorten again to DGTA. When Dow created these rules, it was possible to use the DGTA as a leading indicator of the DJIA, as it was related to the profits from railway companies, which at the time were the sole provider of distribution for the companies that made up the Dow Jones Industrial Average. If the Dow Jones Transport Average was rising as well as the Dow Jones Industrial Average, it meant that distribution contracts were being fulfilled by the railways, which meant that companies were selling their goods, meaning more profits and therefore an increase in stock values. If there was divergence, it meant that there was either uncertainty between the companies or rail performance, and as a result, Dow would be deterred from entering the markets. This tenet can't be used anymore, however, as the Dow Jones Transport Average is primarily made up of airlines whose profits are often based around the fluctuations in the price of fuel and oil, rather than the increase or decrease in goods manufactured by the companies in the Dow Jones Industrial Average. The fifth tenet is that volume must confirm a trend. This is probably one of my favourite tenets from Dow's 6, as it's still extremely relevant in today's markets. When we're in a trend, we want to see volume increasing whilst the trend continues. If we take an example of an uptrend where prices are increasing, buyers are still entering the market as they believe that even at the inflated level of price, it's still a good point to enter and still make a profit from price continuing upwards. If we see volume begin to drop off, we need to see that as an indication that the interest in the asset is exhausting, which means that it'll be a lot easier for the opposing participants, in this example, the sellers, to enter the market and cause a reversal by dominating the market volume. It's also important to remember that if a trend is real, larger traders who are trading with much greater capital than ourselves will also be entering the market, and this again will be reflected by the market volume. We can take the exact concept from this uptrend into the downtrend. This means that we want to see volume increasing as the trend continues, and we need to have an awareness that when volume begins to decline, as we know that buyers could then take over the control in the market. The sixth and final tenet is a trend is assumed to be in effect until it gives a definite signal it is reversed. Now what does that actually mean in simple terms? Well, that means until price forms a lower high and a lower low in an uptrend, we can't actually presume that a reversal is valid. The methodology behind this tenet has been widely adopted by the most experienced traders nowadays. They always try and trade with the trend. Remember, the trend is your friend until the end when it bends. So there you have it guys, another video ticked off in the 365 Days of Forex series. I really hope you guys are finding this useful, and if you are, make sure to hit that like and subscribe button to keep up to date when we upload every single episode in this series. With that in mind guys, cheers and I will see you in the next one.